Hello everyone, welcome back. In our previous videos, we understood what money supply is and how the RBI uses two types of methods, qualitative and quantitative, to control it. Today, we focus on the quantitative approach, which influences the overall money supply in the economy by changing banks' capacity to lend. The major tools under the quantitative approach are the bank rates, repo rate, reverse repo rate, cash reserve ratio, statutory liquidity ratio, open market operations. Let's go through each one of them in detail. Bank rates. The bank rates is the long term interest rate at which RBI lends to the commercial banks. If RBI increases the bank rate, borrowings become costlier for banks. To cover this, they also increase the loan rates for customers. This reduces demand for loans, money supply falls, and inflation is controlled. If RBI lowers the bank rate, borrowings will become cheaper. Bank pass on the benefits, lending increases, money supply rises, and growth picks up. This helps fight deflation. Suppose, take an example. A businessman wants to take a 10 crore loan for expansion. So if bank lending rate increases from 9 to 10%, the business may delay its expansion plan. This will reduce demand for money in the economy and help control inflation. Repo rates. So the repo rate is the short-term interest rate at which RBI lends to banks against government securities. If repo rate increases, bank borrowing cost from RBI increases. As a result, they will lend less to the public. This will reduce money supply and inflation comes under control. If the repo rate falls, bank gets cheaper funds. They will lend more to the businesses and individuals. Money supply will rise, boosting growth during deflation. Say if repo rate goes from 6 to 7%, bank may give lower home loans or charge higher EMIs, making people borrow less. Next one is the reverse repo rates. So the reverse repo rate is the rate RBI pays to commercial banks when they park their surplus funds with RBI. So if RBI raises reverse repo rates, banks prefer to deposit money with RBI to earn safe returns instead of lending to customers. This reduces money supply and help controls inflation. While if RBI lowers reverse repo rates, bank earns less by keeping money with RBI, so they lend more to businesses and people. This increases money supply, useful during deflation. Take an example. Think of it like a saving options. If RBI offers a higher rate, bank will happily keep money with RBI rather than risking giving loans. Cash reserve ratio. So the cash reserve ratio is a percentage of deposits that bank must keep with the RBI. They cannot use this money for lending. If RBI increases CRR from 4 to 5%, bank must set aside more funds with RBI, leaving less money for lending. This reduces money supply and control inflation. While if RBI reduces CRR, bank has more money to lend, increasing money supply and helping during deflation scenarios. So if you deposit 100 rupees in a bank and CRR is 5%, the bank has to keep 5 with RBI and can lend 95. If CRR rises to by 10%, so bank now lend 90. So you can see the impact. Next one is statutory liquidity ratio or SLR. SLR is a percentage of deposits that bank must maintain in liquid assets like cash, gold, or approved government securities. If RBI increases SLR, bank must have to keep more in these safe havens and lend less. This reduces money supply and help control inflation. While on the other hand, if RBI lowers SLR, bank can lend more, increase money supply, and they can deal with deflation scenarios. A bank with 1000 crore deposit may have to keep 250 crore in liquid assets if SLR is 25%. If RBI raises SLR to 30%, now 300 crore is locked, leaving less loans for the bank to disperse. Open market operations. So open market operations refers to RBI buying and selling of government securities in the open market. If RBI sells securities, people and bank buy them, giving money to RBI. This reduces liquidity in the economy and control inflation. While on the other hand, if RBI buys securities, it injects money in the economy, increasing liquidity and boosting growth. You might remember during COVID 19, RBI brought government securities to pump liquidity in the economy so that bank has more money to lend and support growth. Let's have a quick recap. So, bank rates, repo rates, reverse repo rates, CRR, SLR, OMO are tools for quantitative approach. They all affect the overall money supply in the economy. Higher rates or ratios reduces money supply, which are useful during inflation scenario, while lower rates or ratios increases money supply, which are useful during deflation scenario. So in the next video, we will move to the qualitative approach tools, which are more selective and target specific sectors of the economy. Until then, if you found this useful, do like, share and subscribe to our channel. Drop your doubts in the comments and we will take them in the future videos. Thank you and have a good day ahead.